You were told 2026 was going to be the year it all turned around. Mortgage rates were finally dropping. Buyers were coming back. The spring market was supposed to save everything. Then came the war. Oil shot past $112 a barrel. Mortgage rates spiked 40 basis points in 4 weeks. The economy lost 92,000 jobs in a single month. And suddenly, that soft landing everyone promised you, it's looking more like a nosedive. Today we're breaking down 10 signs, backed by cold, hard data, that the 2026 housing market isn't just struggling, it's walking into a perfect storm. We're talking foreclosures rising for 12 straight months, builders begging the White House for a bailout, an entire generation that's given up on ever owning a home, insurance premiums so high they've become a second mortgage. And that number one sign? It's the one Wall Street doesn't want you to see, because it looks exactly like 2008. Let's hit the road. Number 10, the war premium. Oil prices are crushing the housing recovery. Here's the thing about wars. They don't just happen over there. They show up at your gas pump. They show up in your mortgage rate. And right now, they're showing up in the housing market like an uninvited guest at Thanksgiving. In early March 2026, the US got involved in the Iran conflict. Within days, Brent crude oil surged past $100 a barrel. By April 3rd, it hit $112.42, according to Yahoo Finance. That's almost double what it was trading at in early 2025. Goldman Sachs warned that a total closure of the Strait of Hormuz could send oil to $130 a barrel. JP Morgan put the odds at 7%. Now here's where it wrecks the housing market. Oil prices drive inflation. Inflation drives bond yields. Bond yields drive mortgage rates. And mortgage rates had just, finally, dipped below 6% in February for the first time since 2022. That was supposed to be the big moment, the spring of hope. Fast forward to April 6th. The 30-year fixed is back up to 6.46%, according to Freddie Mac. That's 40 basis points higher than where it was a month ago. According to Realtor.com, the market is now heading into April facing more headwinds than at any point since last spring. Housing Wire reported that the Iran-driven energy costs, combined with tariffs and a hawkish Fed, could push mortgage rates even higher. One homeowner on Reddit put it perfectly. I was pre-approved in February. By March, my purchasing power dropped $35,000. Same income, same job, just different timing. And here's the kicker. Last spring, tariff-driven uncertainty killed the housing season before it started. Realtor.com called it a cruel summer. Their analysts are now warning that this spring's geopolitical tensions could cause history to repeat itself. Congrats, we learned nothing. We're just getting started. Let's move to number 9. Number 9. The job market just cracked. 92,000 jobs lost in February. For years, the one thing holding the housing market together was the labor market. People have jobs, so they can pay their mortgages. That was the mantra, the safety blanket. The reason everyone kept saying this isn't 2008. Then February 2026 happened. The US economy didn't just slow down, it went negative. The Bureau of Labor Statistics reported a loss of 92,000 non-farm payroll jobs in February. Economists had predicted a gain of 50,000. The actual result was a swing of over 140,000 jobs in the wrong direction. The unemployment rate ticked up to 4.4%, according to BLS data. Previous months were revised downward too. January went from solid growth to a revised gain of just 126,000. The Wall Street Journal called it widespread and unexpected. CNN reported it was the first month of job losses since the pandemic era. Healthcare, which had been propping up the entire labor market, shed jobs for the first time in years. Federal government employment continued trending down. The private sector took the vast majority of the hit. And here's what that means for housing. When people lose jobs, they stop buying houses. When they're scared about losing jobs, they stop buying houses. The Conference Board's Consumer Confidence Index has been dropping, and it's not hard to understand why. According to the Economic Policy Institute, 1/3 of the losses were tied to temporary strikes. But that still leaves roughly 60,000 jobs that simply disappeared. And that was before the Iran conflict escalated in March, adding even more economic uncertainty. Fortune reported it bluntly. Recession and stagflation risks are rising, and it's getting harder to argue the disruption will be temporary. Let's move to number 8. It gets worse. Number 8. Foreclosures have been rising for 12 straight months. Remember when they told you foreclosures were a thing of the past? That all those pandemic-era protections and record home equity would keep everyone safe? Well, the clock is ticking. According to ATTOM's February 2026 foreclosure market report, 38,840 U.S. properties received a foreclosure filing in February. That's up 20% from a year ago. It marks the 12th consecutive month of year-over-year increases. 12 months in a row, a full year of things getting worse, not better. Foreclosure starts, the beginning of the process, hit 25,928 in February, up 14% from the year before. Completed foreclosures, where the bank actually takes the house back, jumped 35% year-over-year to 4,077 properties. In January, the numbers were even uglier. Starts were up 26%, and completed foreclosures surged 59%. The worst states? Indiana leads the nation with 1 in every 1,597 housing units receiving a filing. South Carolina is at 1 in 2,217. Florida, 1 in 2,277. Delaware, 1 in 2,443. Illinois, 1 in 2,590. Among metro areas, Lakeland, Florida, has the worst foreclosure rate in the country, 1 filing for every 1,075 housing units. Following that, Punta Gorda, Florida, Indianapolis, Indiana, Evansville, Indiana, Columbia, South Carolina, Texas, Florida, and California lead the nation in raw foreclosure starts, 3,390, 3,250, and 2,440 respectively. ATTOM CEO Rob Barber called it a gradual normalization. Normalization. That's a fancy word for it's coming back. And while we're still below the catastrophic levels of 2009 to 2010, the trend line is pointing in one direction, up, every single month, for a full year. It's like watching a pot of water on the stove. It's not boiling yet, but it's definitely starting to bubble. Let's head to number 7. Number 7. Tariffs are adding thousands to every new home. 1 year after Liberation Day. April 2nd, 2026, marked exactly 1 year since Liberation Day, the day sweeping tariffs were announced on imports from countries around the world. Rates ranged from 10% to 50%. It was supposed to protect American jobs and boost domestic manufacturing. 1 year later, let's check the scoreboard. According to the American Center for Progress, the tariffs could result in up to 450,000 fewer new homes being built through 2030. The Brookings Institution found that 90% of the cost burden falls on new residential construction. Yahoo Finance reported tariffs added roughly $10,900 to the cost of building a new home. Here's what that looks like in practice. Cabinets from China, 25% tariff, rising to 50%. Lumber from Canada, 10% tariff. The National Association of Home Builders has been begging the White House for relief, literally going to Washington to meet with officials. Now here's the absurdity. The stated goal was to make housing more affordable, but tariffs on building materials do the exact opposite. They make every nail, every sheet of drywall, every appliance more expensive. The NAHB says tariffs on materials raise the cost of housing, period, and consumers pay for it in higher home prices. NPR reported that the average tariff rate at one point hit 21.5%. Democratic senators estimated American families would each pay about $2,500 more in 2026 because of tariffs. And Reuters reported that on the 1-year anniversary, more tariffs were announced, this time on pharmaceuticals and metals. A builder in Texas told the Houston Public Media, "We're being squeezed from every direction. Material costs are up, labor is harder to find, and buyers can't qualify for loans at these rates. It's like trying to fill a bathtub while someone keeps drilling holes in the bottom." On to number 6. Number 6. Builders are sitting on the largest inventory glut in 15 years. If tariffs are making new homes more expensive to build, you'd think builders would stop building, right? Logical, rational. But this is the American housing market, where logic goes to die. According to the Wall Street Journal, home builders are now dealing with the largest housing inventory surplus in 15 years. They built for the 2021 market, Low rates, desperate buyers, bidding wars, and now they're trying to sell into 2026 reality. That's like restocking blockbuster shelves in the Netflix era. Fast Company reported that 66 of the nation's 200 largest housing markets entered spring 2026 with active inventory above pre-pandemic 2019 levels. 2 of those markets were classified as significantly oversaturated. Builders are sitting on more than 150,000 completed but unsold homes nationally, according to National Mortgage Professional. The numbers at the metro level tell the story. Realtor.com's March 2026 data shows 964,477 active listings nationwide, up 8.1% year over year. In the South, inventory has now surpassed pre-pandemic levels. In the West, it's 8.3% above normal. Homes are sitting on the market for 57 days on average, 4 days longer than last year. And that's the 24th straight month of homes taking longer to sell. Austin, active listings up 9.9%, prices down 7.9%. Houston, listings up 13%, prices down 4%. Phoenix, nearly 30% of all listings have had a price cut, 30%. And what did the builders do? They went to the White House to propose new policies to deal with the glut, according to the WSJ builders, asking the government for help selling houses. In what universe does that not scream, we have a serious problem? Let's keep going. Number 5. Home prices are falling in 34 of the 50 largest markets. For years, the narrative was simple. Home prices only go up. It was practically American gospel. Well, gospel just met gravity. According to Realtor.com's March 2026 data, the national median list price dropped to $415,450, down 2.2% year over year. That's the 5th straight month of annual price declines. The median list price per square foot fell 2.5%. And this isn't isolated. Prices were flat or falling in 34 of the top 50 metro areas. CNBC reported back in December that Zillow projected prices to fall in 22 of the 100 largest cities. Cape Coral-Fort Myers, Florida, was expected to drop 10.2%. Northport, Sarasota, Florida, minus 8.9%. Stockton, California, minus 4.1%. Raleigh, North Carolina, minus 3.7%. Then in March, Zillow revised its forecast even further downward. The original projection for 2026, home values rising 1.2%. The updated number? Just 0.7% nationally. JP Morgan went even further, projecting 0% growth for 2026. Zero, nothing, flatline. In real numbers, the median sale price in Q4 2025 had already slipped to $405,300 from $423,100 earlier in the year, according to CNBC data. That's a drop of nearly $18,000 in 9 months. And the worst part? The South and West are taking the hardest hits. Per square foot prices in the South fell 3.5% year over year. Austin is down 7.1%. Memphis dropped 6.3%. Los Angeles, yes, LA, saw prices fall 3.4% per square foot. The Realtor.com report said it clearly. Sellers look to be pricing more realistically. Translation: the fantasy is over. Reality has entered the chat. Number 4 is next, and it's one that doesn't get talked about enough. Number 4. Insurance premiums are becoming a second mortgage. You found the house, you got the loan, you can handle the monthly payment, then the insurance bill arrives, and your dream turns into a math problem you can't solve. According to The Hill, citing an Insurify report from March 2026, the projected average annual premium in Florida by year's end will hit $8,458. That's over $700 a month, just for insurance. Oklahoma, $5,205. Louisiana, $5,035. Nebraska, $4,560. Texas, $4,529. These aren't outliers anymore. This is becoming the norm. Bloomberg reported in March that home insurance premiums jumped more than 20% in 2025 in 6 states alone. Minnesota surged 34%, Colorado 33%, Nebraska 25%, Oklahoma 24%. Premiums are rising for the 5th consecutive year in 2026, according to Insurance Business Magazine, and the national average is set to top $3,000 for the first time. Housing Wire reported that premiums are up 24% since 2021 nationally. The Consumer Federation of America found premiums rose in 95% of U.S. zip codes between 2021 and 2024. 95%. Fox Business projects another 16% increase over the next 2 years, 8% per year in 2026 and 2027. And in Florida, over 1 million homes are essentially uninsured or underinsured, according to a report by K&C Group. The average premium there is around $6,000, but varies wildly. Some coastal homeowners are paying $10,000 or more. Grist reported that entire states are becoming uninsurable. Here's what nobody talks about. When insurance costs $8,000 a year, that's $667 a month added to your housing cost. For a buyer calculating their budget, that's the difference between qualifying for a loan and getting denied. It's the hidden tax on home ownership that's pricing people out as surely as the mortgage itself. Number 3 is coming up. This one's personal. Number 3, an entire generation has given up on owning a home. This isn't about statistics. This is about your kids, your grandkids, the people who were supposed to carry on the tradition of home ownership that built the American middle class. They've checked out. According to Realtor.com's 2026 supply gap report, an estimated 1.82 million millennial and Gen Z households were missing from the housing market in 2025. Missing. That means 1.82 million young adults who should be forming their own households are instead living with parents, doubling up with roommates, or just not moving out at all. It's the highest count in 4 years. The reason? Simple. They can't afford it. According to Redfin, Americans now need to earn $111,000 a year to afford the typical U.S. home, and the median household income is $85,000. That's a $26,000 gap. National Mortgage Professional reported that 67% of Gen Z adults can't even cover their current housing costs, let alone save for a down payment. Fortune reported that Gen Z has watched the American dream rot before their eyes. Many have turned to what researchers call financial nihilism, spending rather than saving, because saving for a house that costs 5 times their salary feels pointless. The Hill reported that these 1.82 million missing households represent a generation in suspended adulthood. Axios found that 1 in 6 aspiring buyers has completely abandoned their dream of home ownership in the past 6 years. Not postponed, abandoned. And construction fell nearly 50,000 units short of demand in 2025, despite 1.4 million housing starts. Your parents bought a home on a single income. Your kids can't buy one on 2. The housing supply gap has now surpassed 4 million homes, according to Realtor.com. 4 million homes that should exist, but don't. An entire generation that should be building equity is instead building nothing. That's not a market correction. That's a generational failure. Number 2. The West is running out of water, and nobody's stopping the building. Picture this: a desert, a historic drought, record low snowpack, and somebody keeps approving permits to build tens of thousands of new homes. If that sounds like a fever dream, welcome to the American West in 2026. According to NOAA's National Integrated Drought Information System, the winter of 2025 to 2026 was one for the history books, and not in a good way. The western U.S. experienced a historic snow drought. The New York Times reported in March that record heat was colliding with a snow drought across the West, threatening water supplies for the entire summer. CNN reported that much of the region was dry as a bone and unseasonably warm. More than 80% of snow monitoring stations registered below the 20th percentile for snowpack. The Cascade Range in Oregon and Washington had the greatest snowpack deficits in the entire West, according to drought.gov. Colorado and Utah reported record lows. U.S. News warned of a spring of water shortages and wildfires, and the conversation called 2026 a tight year for water supplies. Now here's where it gets insane. Arizona, the state that literally restricted new construction around Phoenix in 2023 because of groundwater depletion, turned around and approved up to 60,000 new homes through a legal loophole, according to Planetizen. A new law lets developers build in groundwater-restricted areas by retiring farmland. In March 2026, Arizona Water Company secured approval for 80,000 more homes in Pinal County. Bills are moving through the legislature to allow groundwater to be sold from rural western Arizona to Metro Phoenix. Rural communities are furious. Meanwhile, a New York-based hedge fund is trying to buy up rural Arizona water rights and sell them to cities. That's not a conspiracy theory. That's from KOLD News and AZ Central. You're building houses in the desert during the worst snow drought in recorded history, while hedge funds buy the water supply. That's not just a housing crisis, that's a civilization crisis. And now, number one. Number one, stagflation is here, and it looks exactly like 2008's evil twin. If you lived through the 1970s, you know this word. If you didn't, you're about to learn it the hard way. Stagflation, high inflation, stagnant growth, rising unemployment, all at the same time. The economic equivalent of being stuck in quicksand while someone throws rocks at your head. According to Apollo Academy, the Federal Reserve itself sees stagflation as the biggest risk to the U.S. economy in 2026. The Fed's own December 2025 projections forecast rising inflation and rising unemployment. Forbes called it the biggest global risk in 2026. Business Insider reported that the economy is on track to grow below trend, while inflation runs uncomfortably hot. And every sign is flashing red. Globes reported on April 2nd, just days ago, that economists are sounding the alarm on stagflation risk. The Wall Street Journal reported that after the February jobs report showed 92,000 jobs lost, markets tanked on stagflation fears. Fortune reported that the Iran conflict has made it getting harder to argue the disruption will be temporary. CNBC explained that stagflation, the toxic mix of slow growth and high inflation, has gone from theoretical risk to present danger. Now connect the dots. Oil above $112 a barrel driving inflation higher. The economy losing jobs. The Fed stuck. They can't cut rates to help housing because inflation is too high. They can't raise rates to fight inflation because the job market is crumbling. Mortgage rates climbing back towards 6.5%. Tariffs adding thousands to construction costs. Builders sitting on unsold inventory they can't move. Foreclosures rising 12 months in a row. Insurance premiums doubling. Entire regions running out of water. A whole generation that's simply given up. Every one of those factors alone is serious. Together, they're the recipe for the worst housing environment since the financial crisis. The difference between now and 2008? In 2008, you had one cause: toxic mortgages. In 2026, you've got 10 problems hitting at the same time. War, tariffs, job losses, insurance collapse, water crisis, generational exodus, inventory glut, price drops, foreclosure waves, and a Fed that's paralyzed. Polymarket, the world's largest prediction market, currently puts the odds of a U.S. recession by end of 2026 at around 30%. Wall Street banks are higher, and those odds were calculated before oil hit $112. This isn't a correction, this is a convergence. And if you own a home, if you're thinking of buying one, or if your kids are trying to break into this market, you need to understand something. Every single, this time it's different argument from the past 3 years just ran headfirst into reality. The perfect storm isn't coming, it's already here. Conclusion. 10 signs. 10 warning flares shot into the sky of the 2026 housing market. And every single one of them is backed by data you can look up yourself. We watched oil prices double and mortgage rates spike 40 basis points in 4 weeks. We saw 92,000 jobs vanish in a single month. Foreclosures rising every month for a full year. Tariffs adding nearly $11,000 to the cost of a new home. Builders begging the government for help. Prices falling in 34 of the top 50 markets. Insurance premiums hitting $8,400 a year in Florida. Nearly 2 million young Americans who've simply given up on the dream of owning a home. A desert where they keep building houses while the water disappears. And an economy flashing every signal of stagflation, the one word the Fed was praying it would never have to say again. This isn't 2008. It might be worse, because in 2008, the problem had one name. In 2026, the problems have 10 names, and they're all arriving at the same time. Before you sign anything, before you write that check, before you bet your retirement on your home's value, ask yourself one question. If this is what the market looks like in April, what does December look like? Don't be next.